All right, folks, welcome to Investing for Beginners podcast. Today, Andrew and I are going to have a little fun. We're going to talk about some metrics and a few different things you can use to analyze companies. Give you like a quickie start, if you will. So, if you're newer to investing, these are some simple metrics that you can use to start analyzing any company, whether it be Nvidia, which is in the news today, or it could be TSMC, or Intel, which was in the news recently as well. Any company you want. So these are great starting points to start giving you I guess, a good heads up or leg up on investing in companies. So with that, I'll go ahead and list out all five that we're going to talk about today, and then we'll kind of break each one down as we go through. So we have the cash flow statement overview. We're also going to look at gross versus operating versus net margin income margins. We're also going to look at the current ratio, understanding debt to equity, and return on equity. Now, if you are new to investing and you're like, I don't understand what this gobbledygook is, we are going to explain each one as we go along, so don't be afraid. Stay with us. We got you. We're going to hold your hand through all this. All right. So let's start with the cash flow statement overview. What does that mean to you, and why is this important to take a gander at?
Yeah. Cash flow statement, income statement. These are financial statements telling you about the big picture of a business. Income statement, it's kind of obvious, profit and loss, right? Like, is the business making money? Cash flow statement, similar thing. Is the business generating cash flow? One of the big differences between those statements, though, is that the cash flow statement lays it out nicely in the way it's sectioned. So the way the cash flow statement is sectioned off, you have three sections: cash from operations, cash from investing, and cash from financing. And those three things are three major categories that help tell you what kind of cash flow is coming from where and doing certain things for the parent company for the entire business. So I'll turn it over to Dave to talk through some of those and give context to why each of those sections are important.
Yeah. So I think if you can kind of think about what they're telling you, each section is telling you, it helps break down a little bit why it's important to think about. So cash from operating activities, for example, makes sense. It's the money that is spent on the business to operate the business. So to pay for the things that they need. So for example, if a company needs to pay for inventory to buy Nike shoes to sell in their stores, then that's money that they're going to spend on inventory. And that comes out of the cash flow of the business. Net income is the bottom line from the income statement, which connects to the cash flow statement at the top of the cash flow statement, and that feeds all the rest of the activities for the operations. So you have things like depreciation and amortization. You have changes in working capital, which means that you'll have accounts payable, accounts receivable, inventory, maybe deferred taxes, maybe deferred revenue, different things that'll be in there that'll indicate money's going in and out of that account. An easy way to think about this is it's like the checking account for a business. So that's an easy way to think about cash from operations. The next section is cash from investing. So this is where the company will use those monies that they generate to reinvest in the business. So things like investments in PP&E or CapEx, which is where they will use money to, let's say, pay for a factory or buy more computers or maybe pay for software. Those kinds of things will be part of investing activities. You also see things like acquisitions. So if companies are buying other businesses, this is where you'll see money going in and out. A lot of companies invest, so they will buy investments. Maybe they'll buy, like Amazon buys Rivian. You'll see that kind of thing in this section. And then the last section is the cash from financing. And so this is where they use the money to raise money to invest in the business. So you have free cash flow, which is generated from the operations of the business less any reinvestments. Then you have the money that they would generate from things like raising debt. So if a company wants to generate money, let's say Microsoft needs to pay for a big project and they want to do it without using cash flow, they would go out in the market and sell their bonds in the open market, and people would pay for those bonds, and then that would be raising debt that they could use to buy another company, for example. Other ways that they could do it is they can sell stock on the market, or they can raise money by doing that, by selling their stock in the market. Other ways that you'll see, or I'm sorry, other things that you'll see in the financing section is also things like capital return to us as investors. So dividends, when you see it, when a dividend is paid, this will be in that section. Or if they're repurchasing stock, which is, or buybacks is another way to refer to that. And a lot of people will refer to those things, and that could be a real easy way for them to return capital. And so those are kind of the three major sections that you'll see in the cash flow statement.
If I could just piggyback on that, just to give some kind of more context, if a company has that last piece, if a company has cash from financing, and if there's more cash leaving from cash from financing versus cash being added from cash from financing, that tells you what growth stage a company is in. And that's not just my opinion. That's what Michael Mauboussin said. And I apologize, I don't have the paper like in front of me. I can't remember off the top of my head, but that's a really great way to look at it. You can take each of the three sections, and he kind of laid it out, because I think he broke it out into like four different life cycles, four or five, but every combination of life cycle. Like, for example, if a company is losing a ton of money, it could be in the decline phase. So, but that kind of inflection point between whether a company is in the growth phase or they're in the profitability, optimizing profit stage, I think he just calls it growth and mature. It is based on whether are they raising a bunch of capital, or are you getting it back in buybacks or dividends? And he has numbers all about like how those perform.
Yeah.
So I think it's good to know.
Yeah, it's very good to know, and that's a great way. The cash flow statement probably, I would argue, doesn't get enough love. It's probably one of the more important. They're all important, but the cash flow statement can tell you a lot about a business and a lot about the management of the business and what they're trying to do. And so it is a really good place to look beyond just the obvious free cash flow metric that everybody wants to calculate and look for, which is obviously critical and very important. But to Andrew's point, the other sections can tell you a lot about the company as well.
Yes. So let's talk about one that maybe gets a little more love. Income statement.
Yeah, it gets a lot of love.
What are you looking at with the income statement, and what metrics?
There's three main things you need to think about when you're looking at the income statement. Those would be the margins of the I guess the three main sections. There's four sections to the income statement, but the three that we're most concerned about are going to be the gross margin, the operating margin, and the net income margin. And all right, so when we think about the gross margin, the gross margin tells us how much money the company would make after paying for the cost to produce the thing that they sell. This is not the bottom line. This is only the profit this is before all the other expenses have to be figured into the business. So this is the gross profit that they make. So the costs that they would be required to make whatever it is they're selling compared to the revenue that they generate from selling that thing. So if they sell widget A for $5 and the gross cost of goods sold, or the cost of goods sold for that would be $2, then their gross profit before other expenses would be $3. So we still have a little bit of ways to go before we figure out how much we as shareholders make, but the company has made $3 on selling widget A.
Yeah, that's perfect. So the next piece of that would be the operating margin. And so you take out some of the other expenses that the company would need to run the business. They probably needed a sales team to get widget A into the hands of stores, right?
Mhm.
So and then maybe they needed some lawyers along the way to hold a hand or two. So maybe if that costs $1, we've now gotten operating margin down. So gross profit was, what was it? Like you said,
Yeah,
three.
$3.
So if gross profit's $3, you take out $1 for SG&A, and now you're at $2. Now we're at operating margin, which still doesn't get you to the full profit that shareholders would get, but we've gotten one level further. And a lot of times when Dave and I talk about the core operations of a business, we're talking about this operating margin because we've included all of the costs for selling, not only selling, but making and selling widget A. And then that's all locked in operating margin. And then the last piece is Uncle Sam needs to take his cut and some of the other like and loose ends, interest and things like that, loose ends that are required for having a business, but the operations are covered by operating margin. So recap, it's margin after how much does it make to cost to make widget A, then how much does it cost to sell widget A? Both of those combined give you operating margin. And then the last piece
Net
is
income margin or earnings.
yeah, there you go.
So this is the coup de grace. This is what everybody in Wall Street talks
Mm,
about is earnings or net income margin. Don't
mhm,
don't get confused by the terminology. They are exactly the same thing. Different people will refer to them differently. When we're looking at the income statement, the net income margin or the net income is the bottom line. It's the final straw on the income statement. It's the last thing that you will see. And this is the result of all the costs to produce widget A, all the expenses to sell widget A, as well as all the gobbledygook taxes and other things that are required to run the business. And what's left over is the net income or earnings. And that is the money that we as shareholders have, air quote, earned from our $5 sale all the way at the top of the income statement. And the way that we would measure that is we would look at the earnings or the net income and compare that to the revenue. And that would give us a margin percentage. And then we could tell how profitable our business was. So let's say the bottom line is we had $1 left of earnings after selling $5. So that means that we divide the 1 by the 5 and that gives us a 20%. And so we have a 20% income margin for our selling our widget A. So that's actually a pretty good profit. So that's kind of how the income statement is set up and works, and that's how you can start to analyze it. And I think, like I said before, try not to look at it in stasis. It's all fine and dandy to look at it for 1 quarter or 1 year, but look at it over longer periods and compare it to others in the same industry. Please do not compare Wells Fargo to Nvidia. That's going to be a very poor comparison, but it's okay to compare Costco and Walmart together, or even Target. All three of those would be a really good comparison. So try to think of like to like as opposed to opposites attract, and that's a good way to start looking at the income statement.
yeah, I mean, if I throw a dart at the wall and I pick what was the net income margin for 2022, doesn't tell me a thing. But if I'm looking at a 5-10 year period, I can see how it's moving. And that trend can give me an indication on the health of a business. Is it getting better? Is it getting worse? Is it staying the same? And that tells you how is it rocking and rolling? Are profits rocking and rolling, or are we hitting a rough
Right.
patch? You can see them in the margins over time.
Yep. Yep, exactly. All right, so let's move on to the balance sheet. So this is a metric that we would use to measure the health of the balance sheet, and this is called the current ratio. Would you like to tell our fine listeners what the current ratio is and how we calculate it?
Yeah, pretty simple. Half of it's in the name, current. So current ratio, current assets divided by current liabilities. And those are the things. There are assets, there are liabilities. I think a lot of us can kind of intuitively understand those two concepts. But in a balance sheet, so now we've moved on. We've hit cash flow, we've hit income statement. Now the balance sheet, the one that nobody wants to talk about, the one that's so neglected the most, except by bank analysts and Mike Mayo.
Right.
He's like the only one
Right.
who looks at balance sheets. The balance sheet is separated into two parts. You have the short term assets and the long term assets. Same for liabilities, short term and long term. And they define short term as 1 year or less, and long term as one year and greater. So the idea of the current ratio is it's telling us what are that current assets, current liabilities, what is the short term picture of what the company owns versus what they owe. And that can give you a viewpoint. If that number gets really, really low, then, a company might have, let's say a company has like 300 ice cream shops. But if if they come through a rough point where it's the middle of December and nobody wants to buy ice cream, but they still have to make payroll and pay everybody at every 300 stores, that could be a problem. And if you combine that with a recessionary market or some market panic where you're not able to raise money quickly, that's how companies go bankrupt. It doesn't happen very often, but it definitely has happened. And as investors, we want to try to avoid that as much as we can. So that's why current ratio is important. And that's kind of the context behind calculating it.
Yep.
Do you have thoughts on it?
Yeah, a couple thoughts. Number one is it's really, again, it's really important to look at current ratios over longer periods of time. Again, 1 year in stasis will tell you a little bit, but not a lot. And so looking at it over a longer period is a really good idea. Also, comparing it to others in the same industry is also a really good idea. And you also probably want to look closely at what contributes what contributes making up words here.
Fancy.
What contributes to the assets and the liabilities. So does a company have maybe a lot of cash and not a lot of other current assets? And likewise, does it have a lot of debt and not a lot of other current liabilities? And in and of itself, those things aren't good or bad, but it's things to understand about the business. So like if it has a lot of cash and it has a lot of debt and doesn't have a lot of other things, it could be early stage company. And so you wouldn't expect it to have as much inventory as Walmart or Costco, right? So that those kinds of things make sense. But you do want to just kind of glance at those things to have a little better insight into what's contributing to the current ratio, good or bad. So you have some sense of where that's going. And then I guess the last thing I would say is that I think Warren Buffett said in his last shareholders meeting that he spends the most time looking at the balance sheet, which is contrary to what most people do, including sometimes myself. And I think that is a good reminder that the balance sheet can be a very, very useful thing to look at, and we shouldn't just ignore it for the glory of the income statement.
No.
All right, so let's move on to the next one. So this is debt to equity. So this kind of stays the with the balance sheet, and this is another way that we could kind of measure the health of the business. So what is the debt to equity, and what should we look for with that?
Yeah. Again, you can hear the ratio to get clues as to how to calculate the ratio. Debt to equity is going to be debt divided by equity. So you have long term debt divided by equity. You could have total debt divided by equity. Long term debt tends to be more used as the ratio there, but it gives you a sense for the companies that are more capital intensive, meaning they have more assets on their balance sheet, gives you a better sense of their ability to be solvent. So in the first case with the current ratio, we were talking about the short term, the current situation with the current ratio. This one's more of a long term thing. Okay. Is there a ton of debt just in general, which leaves a lot less margin for error? Maybe, interest expenses are going to be really, really high. So even if the business does pretty good, all that money is not going to go to shareholders because they're paying interest on debt. Or maybe that does turn into wow, we're really struggling to pay debt here. And so we're going to have to raise a bunch of capital through dilution. And now you've got a reverse split where your stock is now basically split into tens or something, which has happened and does happen. So understanding what the debt to equity picture is can help you avoid some of those situations, with the caveat that asset structure matters and how assets drive a business's profitability also matters.
Could you explain that a little bit?
Yeah. Let's go back to the ice cream example. If I were to make an ice cream business, that would be pretty capital intensive because I would need to commit to either buying the real estate or renting the real estate for a long period of time. And along with that comes the building and the costs and the maintenance and all those things are those are all a long-term asset, the buildings and the land. Something like that is going to be a big expense and it shows up as an asset on the balance sheet. Compare that to a software company where it costs $30 in AWS fees a month to run our little website. It's not going to be there's not going to be a lot of assets on the balance sheet. So it's really just based on the way accounting works today. If you're making huge capital commitments, those tend to show up on the balance sheet. If you're just hiring a bunch of people to make something like software, it's not really going to show up on the balance sheet unless somebody acquires you, buys your business, and then that valuation's on the balance sheet. So I know it's weird. It doesn't weird really make sense. And I agree with you, but that's just the way it is. So we have to deal with
Sometimes that's just the way it is. We just got to deal with it. So
it.
accounting doesn't always make sense. If you want to hear, if you
No.
want to hear a commentary on accounting, just listen to one of Professor Demoteran's lectures, and you'll hear commentary on accounting. Anyway, no offense to accountants out there. So the thing about the debt to equity is it like every other ratio, you have to you can't really look at it in isolation. You have to look at it in relation to how the company has done in the past. Longer periods of time are good to look at because they can give you an indication. Maybe, for example, let's say a company goes out and buys another business and they use a lot of debt to help finance that payment, but they only do that once every 10 years. Well, depending on where you are in that cycle, you may see a huge debt to equity number, and that may be out of character for them. Let's say they normally run lower debt to equity numbers, and then all of a sudden you see this huge spike. Well, that in and of itself, if you see it in that 1 year period, you may think, oh my goodness, I'm out, forget this. But if you don't dig just a tiny bit deeper and see that this was an acquisition that they made and they did the same thing 12 years ago, and then over the course of the time between, they paid the debt down because they have cash flows to do that. That's one way that the business uses to improve and grow their business. So in and of itself, it's not a bad thing, but it's always good to look at. Now, likewise, if you see a really high number for a really long time, then that may be another issue to look at. But that's why looking at it in longer periods of time can be way more helpful than just looking at it at a 1 year thing. And I guess the other thing is when we first started out doing this 7-8 years ago, I was of the opinion that anything above one was taboo, was bad, and I've kind of moved away from that idea, and it's more about what has the company sustainably held debt for and what are they using it for. So going a step further than just looking at the ratio and calling it a day, looking at a longer periods of time, and then also understanding why they're using the debt and how they're using the debt can have a big impact on that number. So it could be a really good screening tool, but always understand, in finance and investing, there's always going to be a but. And sometimes the buts are bigger than others. But so I just think that it's good to look at it in context because that can give you a better sense of whether it's a good or bad number.
Well, it should cause you to think more and not cause you to think less. That's the whole point of doing these,
Right.
right?
Yes. Ask questions. What you want to
Ask
you
questions,
you want to
yes.
ask questions. Why, like little kids, why does this do this, why does this do that, and that will lead you to a little deeper understanding of why they're doing that. And you may not know at first, and that's okay, but it's good to ask those questions because it will force you to dig deeper.
Yeah. I this is 7, 8+ years of being in the
Yeah.
trenches advice.
Yes.
I can't believe we still give this away for
Right.
free.
No, exactly. Exactly. But it's lessons learned along the way for sure.
Yeah.
For sure.
Yes.
All right. So the last metric we wanted to talk about was return on equity. What are your thoughts on return on equity?
Yeah, return on equity. Warren Buffett's famous, one of his favorite metrics, trying to tell you how efficient a company is at being profitable, and not just from the income statement side, but really looking at a a longer term picture. So if again, I'm making ice cream shops and let's say I'm buying 3 of them. And then let's say my evil cousin in a different town is buying 5 of them. And let's say we both made the same profit after a year of doing that. Who did the better job? Well, obviously it wasn't my cousin in the other town. It was me because I did more with less. That's what return on equity is trying to do. Tell you, how is the company doing? Are they just growing to grow and they don't care how much money they spend? Or are they being efficient and growing with less? Because what does that do for us as shareholders? Well, that just means more cash gets to flow back to us, or they can grow at a faster rate than somebody who's just buying ice cream shops because they felt like it wherever they wanted. So return on equity is a great metric for helping you see where a business is really good at executing and being efficient.
Yes. Yep. Exactly. And Buffett has been trumpeting the benefits of looking at return on equity for 50 plus years. So he's a very big fan of it. It's a simple ratio to calculate. You take the net income from the bottom of the income statement, and you also take the shareholders' equity or the book value from the bottom of the balance sheet, and you divide net income by shareholders equity, and that gives you return on equity. And it's a great way to measure pretty much all businesses because you're measuring net income and shareholders equity, which banks produce, as well as Nvidia. It's something you could use to compare the profitability of a lot of businesses across different sectors, kinds of things. So if you're looking for companies, you want profitable businesses, and you're curious about how maybe different industries stack up, that's one way you can do it, is by using return on equity as a way to measure those. And I know Buffett is a big fan of anything of 15% or greater, and so that can be a good benchmark if you're looking. Now, I don't know that I would necessarily kick 14% out of the investment idea, but maybe if you see something that's consistently at 5 or 6%, maybe a pass kind of thing. So again, in stasis or in isolation, not great. Looking at it over longer periods of time, comparing it to historical performance as well as others is the way to fly, because that will give you a much better sense of how profitable and how well the company invests. Because this is basically an investment metric. It tells you how well the company generates profit from its assets and its equity. So the better it does, the more profitable it is, and the better it is investment for us.
100%. I love the way you broke that down. And thanks for the guidelines too. That's a great measuring stick to get, an idea of what's good, what's not, and how we can try to learn more and do more. So let's say somebody's out there. This stuff sounds pretty cool. It's interesting, but it's overwhelming. What kind of advice would you have for somebody like that who knows they want to learn the stuff eventually, but might just feel a little overwhelmed at the moment?
Well, the thing that I have found that's the most helpful for me, I'm a visual person. And so I have spent the last 4 or 5 years creating all these infographics that you might have seen on places like X or Twitter or LinkedIn. And we basically put a bunch of them together to help you as a starter pack, if you will, to start analyzing businesses. And we created I have 10 infographics that are created in one PDF that are free. You can just go to investing.com/
investingforbeginners.com/visuals.
Thank you. Perfect. Okay. Leave it to Dave to screw that up. We put this together for you. It's free. It's a free resource, and it could be very helpful. It's a great way to learn. This is how I've learned over the years, and I find it very helpful. And hopefully, you will find it helpful to understand. It's one thing to talk about it, but to see it on paper, it's like, oh, I get it now.
Yeah. And it's free for now. I'm going to be that guy. It's free for now.
Yeah.
So seriously, if you want it, go get it now because it's for now. But appreciate you bringing all this to us. This was a super great, turbo speed explanation. Yet at the same time, you sat really nicely on each of these. So I'm hoping people found value, and hopefully we're all getting better at analyzing businesses.
That's what the goal is, right? Try to get 1% better every day.
Love
Yeah.
it.
All right. Well, with that, we'll go ahead and sign us off. You guys go out there and invest with a margin of safety, emphasis on the safety. Have a great week, and we'll talk to you all next week.